Okay, so basically we're looking at range theory. The actual concept behind this is Wyckoff theory. And that's like my very first approach to trading the forex market in a technical perspective. Okay, so I came across different ways of trading Wyckoff. So there were some times whereby people always argued and debate on socials about how schematic is just schematic one and two, right? And then there's a whole lot that most people don't know when it comes to trading Wyckoff theory. It will shock you to know that there are more than one schematics and more than two schematics for every accumulation, right? Accumulation, you would think is just schematic one or two, but of course, there are more than that. Also, when it comes to redistribution, there's redistribution one and two, three, four, right? But the common ones you will see are the regular redistribution one and two. All right. Now, funny enough, even when it comes to redistribution, not everybody know that, okay, yes, there are more than two schematics. Okay. So we're looking at range theory today. I'm going to be talking about this concept, what it actually means. Now, this PDF will be released February 1st, all right? But I'm going to scan through some of the information I'll be talking about here, all right? And then we'll look at the chart itself, look at backtested theory with this, look at previous analysis we did with this, and then we can also use it to forecast possible movement in terms of what is expected this coming week. So we'll try to do this all within 40 minutes. So let's see how fast we can go in, because I'll give you like a tip and a short explanation of every single thing. So your attention is needed. That's all. All you have to do is stay quiet and just listen. Because if you listen, you get to understand the concept a lot better. All right. So range, we all know what ranging market is like, right? I'm sure most of you have trained ranges, right? And it's not a new term. We're just getting to hear range for the first time. If that's like your case, you're getting to hear this the first time. Okay, I will say sorry about that, but I think this is something that everybody should be aware of. So before someone will start annotating on my screen, I've disabled that. Thank you very much for indicating that you want to annotate. So moving on, a ranging market, also known as a sideways or horizontal market, is a financial market where the price of asset traders with asset trades within a certain tight range, right, without showing a clear direction. So it's more like there's indecision in the market. It's just like if you already studied candlestick indecisions, right, or bilateral chart patterns, you know that, okay, that kind of chart pattern that doesn't signify buys or sell, and there are also patterns in terms of candlestick that doesn't show buys or sells. So this time around, we're talking about a full range. Now, there are some complications associated with trading with ranging market. First of them is limited profit opportunity. We have false breakouts. We have increased choppiness and whipsaws. We have difficulty in identifying the trends. Okay. We have risk of over trading. We have market psychology impact, and navigating a ranging market requires adaptability. The ability to know that, okay, yes, this range is ending here. Let me cut my buys, entering on shorts, cut my shorts, entering on buys. All right. Things like this happen over time. Now, the most important thing when it comes to trading the ranging market is timing. Through this, though this theory is based off trading with ranges, but we can't ignore the senior colleague, which is timing. To make this concept an easy one, we'll talk about timing. Every market today has various volatility periods. Some pairs are most volatile during London session, some during New York session, some during Sydney session or Asian session, right? You know how most persons don't trade Asian session and they believe that they must see a break out of Asian range before they can take opportunity, that those who actually still trade within these ranges. Okay. Now, the next thing we're also going to pay attention to is the time frame we're using to determine our range. All right. Trading time frame refers to different periods of time used by traders to analyze and make decisions about financial market. Okay. I just realized that. Okay, let me see. Trade the financial market. Now we have different type of traders. We do have those who scalp, those who day trade, those who swing, and those who work position trade. With this concept, you can either scalp, day trade, or position your trades, any of them. Okay. And for this theory, we'll be focusing on using some specific time frames, right? According to this book, I specified 4 hours, 6 hours, 8 hours, 12 hours, and daily. But then again, I'm going to be showing you some weird time frames that we could also reference our entries from, such as 23 hours, 21 hours. All right. Sometimes if I want to even get more extreme levels, rather than using the 1 hour time frame, I could use the 90 minutes time frame. So it's more like saying I did 1 hour, 2 hours, add them together and get the middle ground, which is an hour and 30 minutes. So if you're basically saying 60 plus 60, that's 120, you divide it by 2, you get something different. But if you're saying 2 hours, which is 120 plus 60, that's 180. 180 divided by 2 gives you 90 minutes time frame. All right. So those are some of the time frames we'll be utilizing. But in the book, I've specified your best bet will be using the 4 hours, 6 hours, 8 hours, 12 hours, and then the daily time frame itself to get the actual direction of these ranges. Now, understand the concept is quite easy to trade. You just need to have understanding of every single thing. So the first thing I want to look at is the rules that govern this concept. Breaks. In as much as we're focusing on the range, we do not want to understand what the chart did previously. Highs and lows need to be swept to validate this range. So I'll talk about this. How do we know that, okay, yes, this is a valid range and this is not a valid range, all right? If we also look at the image on the screen, you notice that the image on the screen above, the red line is the last low that was created before we actually see the formation of that range, right? So before you see this range, I think I just have to annotate at this point. So before you see this range, right? So where's the major low? This is the major low. So we see that as our major low before that actual range came in. So we see this low, the market did these highs, then there's a range here before market sold back down. Now, so some of these rules will be considered, and we have different types. So for the purpose of this concept, we are going to be maintaining a fixed risk to reward ratio, which is best to use 3R or to use 5R. For me, I focus on using 3R. Even in the book I was studying earlier on, Global Macro Trading, their preferred choice of reward is always 1 to 3, right? If you're risking 1, you are sure that you're going to get 3. And the good thing about refining to lower time frame is that it gives you a better risk to reward ratio. And that even though you're getting 1 to 3 on 2 hours, right? If you get a 1 to 3 on 15 minutes, price gets to your take profit faster than if you're on the 2 hours time frame. So for the concept, I'm going to show you the rules. Remember the book, you are going to get the book. So you can choose to screenshot, you can choose not to. So I will advise you don't even screenshot it because you still get it. And that's why I didn't show some parts. If you look at this is the 4th page. So moving on, we're going to be having some conditions. So I want us to just focus on the rules, how we utilize this concept, right? Now, the first thing is we want to focus on the range that is being created, right? So every range is important. So if the market is to move, it will create range and then something like this, right? Sometimes market might just be ranging for several days, several weeks. You want to wait for that breakout. So if you do follow me on Twitter, I've created a thread for you guys before, RIMC, range initiation, mitigation, continuation. So whereby market ranges, it push out to the upside, break out to the upside. So this is the range, right? And this is the initiation, right? The reason is the initiation because this is the move that broke out of that tight range. Then price comes back to mitigate, right? And then what continues? RIMC. It's a very simple concept. Same concept relates to this actual concept also. Now I want to see the range. Now, even in every tight or huge range, there will be that unique small range within it that we can make reference to than to take the full thing. The idea is to cut short your risks and increase your reward. But then again, if you want to achieve a 1 to 3 faster, if you're putting your stops here and then you're doing 1 to 3, you notice if you refine it indeed, you get a 1 to 3 within a short period of time rather than holding for this long. All right. So that's one of the reasons why it's also important to use lower time frames. Okay. So that's one of the importance of utilizing the minutes time frame. Now, the next thing we want to look at the momentum that breaks out of this range. Is it bullish? Is it bearish? Right? The candle should be aggressive. That gives us the actual definition of that range. Now, the next thing is what range is created. In these categories, we have 2 categories. This is the first categories, right? The first category is type A and type B. We'll look at the next category later on. Now, this type A is basically 1 minute. Give me a minute, please.
You know, say Zoom and you wait for person. You know.
Yeah, I don't know. 1 minute. Okay, I think I just have to continue. Okay. So moving on, we want to see how market breaks that range, right? So type A is our reversal type of range. Type B is our continuation type of range. Okay. So we want to know, is the market reversing or is the market continuing to the upside? So those are things we want to pay attention to. If we're looking for reversal, we'll look at the rules very well. If we're looking for continuation, we'll also look at the rules very well. It's as simple as that. Okay. So moving on, price must take out the low or high before the creation of the range. This is something that is very, very important. Okay, price must take out the high or low before the creation of that range. So we're going to be looking at charts to utilize this concept. So like I said, most of you want to take a screenshot, but understand that you'll get the PDF. We can refine the range into just single candlesticks. For example, in a bullish range, we focus on using the last sell candle as the extreme range. So if we scroll up, look at this. We do have this as our range, right? Market creating choppy movements, right? And then this is the first attempt to break that range. So ideally, is this a clear shift in the market? No, because there's nobody. But then again, that's the first attempt to take out the range, right? Now, when we see that happen, we're looking at this high. That high was swept off by this. That's a clear grab of liquidity. And then this is the last range in terms of the last bear candle. We can't say we want to take this full range and put our stop loss here and then be targeting 1 to 3 above. Like I said, if you're refining this, it is becoming better and it becomes better. Okay.
Yo, who's this guy in the chat dropping? Okay.
Yeah. I'm trying to disable the chat. So the thing is, most persons would always do the wrong thing, but it happens. So I'll just continue. Okay. So moving on, we want to see price do this. What happens? Breaks out of the range, right? Creates a new wick above, comes back to that level, mitigates, and then push up. Now, sometimes if you're trading SMC or ICT, most times you want to see confirmation, like inducement, before you validate that level. Now, in this concept, we are not paying attention to all those information. It doesn't really matter. What we're interested in is the high before the range, right? This high, then takes out that high, then validates our range. We expect price to come back and then continue. And then the low before that range, this range, when it breaks, takes out this low, comes back and validates, because taking out that low gives us our clear shift of trend. Then we understand, okay, yes, this is our continuation type of range because this market is bearish, this market is bullish. Then in the case whereby it is opposite, right? So let's assume this high was created in this range, it breaks this level. We now know that market is about to what? Reverse back down. So this is our what? Our type A range, and then the continuation is type B. Okay. So if the range has too many candles, we can't just ignore it regardless. We can leverage on using the mean threshold. For simple terms, using 50%. So in a case whereby we have too much of candles and then there's no actual refined level, and maybe that range itself contains so much amount of candles, we can choose to still make use of it. All we'll have to do is do 50% of our entry. That's our mean threshold. And then we'll take our entry from 50%, then your stop will still be below here. All right. So regardless, you're still taking the setup. The only difference is your risk is going to be more in terms of pips, but in terms of percentage, you're still risking the same amount. So that doesn't really change. Extreme target on higher time frame is depending on if the range is a type B or not. And if the range is type B, we might want to target previous major highs or lows, depending if it's bearish or bullish. All right, so let me explain that. So let's assume we have this. Then market did this, right? This is a range mitigated. Then we can decide to target here or target this level, right? But ideally, we say we'll just be using a 1 to 3, right? So your entry and your target. But in a case you want to hold this position as a swing entry, you could target previous range. So let's assume market did a range here, broke, then this happened, breaks this, invalidate this range, and then gives you another range. And when you're taking this range here, you can target this extreme level, Now, there will be reaction of this point, right? What you can always do is take profit on this level. So you could have multiple entries, or for those who prefer to always use the concept of taking partials, you can always take partial, or you can trail your stops if you prefer that. You can always trail your stop by moving your SL into profit every single time a major higher low is created. All right. So once this higher low is created, it's protected, and because it's protected, you don't expect price to break it. The moment price break any significant level, right, then there's possibility market wants to change its direction. Okay, so now let's look at one example here before we move lower. So if you look at this example, like I said already, I did mark out this range here. All right, then marked out this range, mitigate this level, and goes above. Now, liquidity is also important. If we look at the image above, we see both buys and sells playing out, right? For the buy to understand that understand that there's liquidity below it, right? Which is this. So you see that mitigated a range before. So you see this actually is also a range, a very tight range. Market mitigates it and then pushes back up, created a new range before it finally gives you this swing trend. So how do you know the trend has changed? It's when this significant higher low has been taken out and price fails to create a new high. What happens? You see that level creates a new lower high, and then market gives you our first shift, indicating that market is changing its direction. And this is another tight range that price taps into before selling back down. Okay. So moving on. We have liquidity right underneath the range that was created, and that is acting as a price magnet later on. That level has been marked out with sell side liquidity, SSL, all right, meaning sell side liquidity. The sell range leg took out that liquidity, resting under the buy range before coming back to the supply and then running off, right? So what you notice here is after this buy played out, this range here took out this low before coming back to mitigate it and then coming back down. So that's one thing you need to understand. In the supply range above, we didn't necessarily see our second rule. Remember, I talked about the rules, right? Now, the second rule is what? Momentum break out of this range, okay? We didn't really see that happen, okay? And that's if you look at it, momentum after that range was created, there's no momentum break. This is just candles moving back to the downside, okay? But regardless, it played out. And why is that? It is due to the fact that the overall trend is actually bearish. So I do have a picture showing the overall trend of this market. Let me see. Where is it? This is the overall trend. So what you see here is the market is actually very, very bearish, creating highs, lows, just like that. Pull back again, continues, comes back again, then continues back to the downside. Overall picture is the market is what? Bearish. So in a bearish narrative, you want to focus on looking for sells and constantly looking for shorts. Every opportunity you get is to get higher levels to sell from. So one of the most difficult part of this concept is patience. If you're not patient enough, you will not be able to get entries, or you just take unnecessary loss before price actually comes back to your range. Now, like I said, this reversal type is what? Type A range. Now we're going to be looking at the next one, which is our continuation type of range, all right, which is type B. So the rules are still the same, whether in a reversal or continuation, right? What are the rules? The rules are simple. Range created with fewer candles, momentum breakout from this range, either it's a bullish break or a bearish break, the candle have to be aggressive. It gives us confirmation that yes, buyers are in the market in the case of a bullish trend, or sellers are in the market in the case of a bearish trend. Now, type of range created, we need to identify, is it a continuation, which is type B, or is it a reversal, which is type A? And then price must take out the previous lows or high before the creation of this range. Now, if we look at this movement, for example, now market gave this move high, low, high, this range. So in our last rule, this is the last high that was created before this move to create the range. And now this is our range, which is the first step, identifying the range. Once we have done that, we want to look at the last bearish candle, right? I'm not interested in how the candle is formed. The candle can be like this. I don't care. The candle can be like this. I don't care. The candle can be with a small body along with, I don't care. If that is the last momentum in terms of sales, because that's like market is buying, and that's the last level we see sellers coming to the market, I'll be interested in what? Buying with that candle when price comes back, and then expect price to push higher. All right. So we have the overall range. Then we'll narrow down our range. Like I said, instead of taking the full range, you can always refine. Now, if you don't want to refine, you can take the mean threshold. Now, if you had done that, you'd have missed your entry. You see that price did not come back into that level. Now, another thing I do to refine my zone, even though I've taken this, I could always take mean threshold again, right? And then have a better risk to reward. So if I was looking to swing, I have like 2 entries. Rather than risking, maybe I want to risk $500, I could split it 250 each. Because ideally, if you're doing 500 and you want to make 1.5, that's a 1 to 3, right? 1.5, 1 to 3. Now, if you also want to make the same 1.5, but with lower risk, and you're risking 250, you just need a 1 to 6, right? Both of them will give you 1.5. The only difference is the person who go 1 to 6 risks 250, you risk 500. If the person are taking a loss, it will lose 250. If you take a loss, you lose 500. But when both of you get to profit, you are both making the same amount, 1.5. It's as simple as that. So the lower the risk, the better for you. So what do you see in this case? You see like a very simple narrative. Market goes far from our range, right? Create the range and bought before coming back, mitigate. You see the mitigation is also very clean. Now, if you also wanted to get in, there's another range here. See this range here, right? And then what happens? Aggressive movement to the upside, breaks this high here before coming back, mitigating that same range, and then pushing back to the upside. Now, ideally, with my rules, I won't take this because it doesn't like satisfy the rules. But if we look at this, right? So this, we look at the last high. This is the last high. After this happened, took out this last high, right? This last high is very important. This is like the fourth part of the rule. Now, once that happened, this is the range that was created, all right? This now is the continuation type. This range that was created. So we want to refine back into the last bullish bearish candle. Now you see this, right? So this was taken out, momentum to the upside. This is a what? Type B, TB or TYB, anyone you want to rename it as, right? So market comes back, mitigates, and then continue back to the upside. You could have targeted this liquidity here, which is like your buy side liquidity. Okay, so that's for this. I think it's best if we look at charts now. Enough of the example here. I do have a lot. So let's go to chart itself. On my left is my 21 hours time frame. On my right is my 4 hours. But like I said, we could always start from the normal time frame, your weekly, to get like overall picture. What you see here is a clear indication that buyers are still in the market, right? So we have this, we have this, we have this. Now market is selling. So you don't want to be blinded by taking buys or sells at any usual level. Now, for those who would want to go into the usual time frame, you use your daily, right? Like I said, we always want to look at our demand first and then our supply. So if we're looking at this, what do you see here? Now, initially, I was thinking the same way when I saw, okay, this is our demand. But in terms of the rules we make use of, is that a shift? Is this a shift with body? Of course not. So I don't really play this as entry. It might be a very dangerous level to look for buys. Now, rather, I see this as well, a liquidity zone for price to sweep out that level, right? So my eyes are on this level to be what's taken out aggressively, and the market continues lower. But we're not just going to say it, we're going to look at chart itself, and then we'll determine what the market is doing. Now, ideally, if you look at this, this is the last significant supply you see here. All right. Now we're going to refine this. So first start with 23. Now on the 23, you see that as a last candle. Now, following the rules, the first thing is the range must be created with few candles, right? So if we're marking this range, we have few candles, correct? That first rule has been checked. The next rule is momentum must break out from this range, either bullish or bearish. What do we see? We see a bearish break out of that range. And what do you see? Aggressive candle to the downside. Checked. The next thing, the type of range created. Now, this is a reversal, right? Because market was first buying before it created the range at the extreme and then start selling. So this is what our type A. Okay. Then that final thing is the low before the range was created, or the high before the range was created. Now, in this case, the market is what? Bearish. So we want to reference the low before the range was created. So we see this low here, right? So this was the low, took out that low before coming to create that range, and then it's valid. So we have our 4 rules checked, okay? And because of that, we'll make reference to it. So as always, let's go into lower time frame. But first off, looking at this, what do you clearly see? You see a simple example. So I do want us to look at pictures of our past examples before we actually look deeper into it. Now, if you look at my Discord, I'm sharing my screen now. You can see this. I don't know. Okay, I think I'll open it in browser. Maybe I'll be able to zoom in. Okay, I'll be able to zoom if I open it in browser. Sorry. So I've opened it in browser. What do you see here? You see the range. This is the last high before the range was created. Market create that range, we pick the last bearish level. Even though we have multiple candles here, taking the last amount of sales, and then you see that shift to the upside, aggressive. So this is a what? A type A, right? Type A, 1. Then the next thing is the low or the high, taking out, yes. Range created a few candles, confirm. Aggressive break, yes, you see the aggressive break to the upside. Now, those who would have taken buys from this area here, which is quite risky, right? Those would have taken buys from here because they agree that this is the last range before this break. But then again, yes, you could have gotten in on this, mitigated, pushed back to the upside, failed to close above this, making this level a buy side liquidity or a level to watch out for price to come back to and react from. All right. So what happens? Market fails to break that level, come back down, take out this previous low, pushes back to the upside, giving us reasons why this level should be swept, mitigates our entry on the dot. Now, if you had used mean threshold, your risk could be lesser. And then what happens? Pushes back to the upside. Even when price attempts to come back, doesn't come back to your exact entry. All right. So that's what you see here. A very simple example. So if I was to open the next one also, continuously, you will see the exact same thing playing out. So we see this, the last high before the range was created. We have this last high, range was created, aggressive break to the upside. What type is this? This is type B. All right, type B, last bearish candle, market comes back, mitigates, pushes back to the upside. And then what do you see? Market continues going to the upside. It's a very simple concept. You don't really have to stress. Just on that, have a clear understanding, and you're good to go. So open more examples. You see that again, yeah. All right. Mitigate, pushes back to the upside. So the last high before that level was created, you have this level here. We do have this high. All right. We have this high, right? This low, low to high, pushes back down, breaks, create the range, break, it shifts, right? Market comes back and then continues. Like I said, I don't really pay attention to whether you would have inducement or not, but if you do, it gives you added confidence. But ideally, price is expected to react. So let's look at sell example, same thing here. Okay, I think I'm going faster because of time. It's about 3 minutes before the call ends. So we have this low. this as a result of fundamental. We have the actual low here, another high. So high to low, pushes up, creates the range, breaks that level, right? Validates it. For those who trade inducement, this is a valid inducement because it took out the previous low, right? What happened? Market pushes back, mitigates, and then all the way back down. So that's example on that sell. Let me see if I can get more short examples. Do I have sell again? Okay, I do. So we see this example also, last buys. Now, in this case, do you see momentum break to the downside? No. So that means this would have been a very low probability setup of playing out, and it's quite risky. Of course, every trade you take is going to carry some of risk. And as always, you risk what you can afford to lose. If you can't afford to lose it, don't risk it at all. So if we also look at this, we have a momentum break. So we have the last low, right? Last low, high. This low was broken. Price rallied back up, came back down, created a range. Now, this is the full range. Aggressive break to the downside, a shift, all right? And then inducement also. It takes out the previous low to validate that inducement. Market comes back, mitigates, and then what do we see? We see price shooting all the way back down, right? And this is more than a 1 to 10. So this concept gives you higher risk to reward ratio, and then it's easy for you to profit off. I'm going to send a new link. On that link, we're going to be looking at gold. This link is about to end, so I'll just end the call, start again, and then we'll look at the practical analysis of looking for these ranges on a live chart, not just a chart that I've already played out. Okay, so I'm ending here, and this is the video that will be uploaded later on YouTube. Nothing more, nothing less. So just a sharp summary. And like I said, you will get a copy of the PDF if you do fill the form. I've released the form and it's on Telegram. You just have to fill it, and that's it.